Good evening, and sorry for the network issue that I had. Welcome our students to our first tax class. I pray and hope that the network will allow us to have a hitch-free class today. Thank you so much for your patience. We want to go straight now to our lecture for the evening. So let me share my screen so that we can sorry once again for the embarrassing network problem. So let me share my screen again so that we can follow along. So our first class is on basis of assessment of profit for sole proprietor, partnership, and company. If you look at these items, these are business items. These are businesses, a company, a partnership, and a sole proprietor. These are business accounts. And so the owner of a business can be a sole proprietor, still a person, a sole proprietor, a partnership business, and a company is a person of his own. So when it comes to business and not employment, how do we tax these individuals? We're going to be looking at the commencement rule, the change of accounting principle, and change of accounting date, and the cessation rule. Now let's look at the first one. AYZ company commenced business. So the word commenced business here shows that it's a commencement rule we're going to use. Now, this date it commenced business, April 1, 2006, is important because we are going to use it twice. Making up accounts to 30th June every year. This end of accounting date is also important because it is how the accounting statement, the account statement will be presented as at that day. Now look at the results that were extracted from the books of the company. Now you see they said period ended 30th June 2007. It shows that they will be giving you accounts ending in 30th June. Now when you see the word period ended or period to, have it in mind that this period is not a 12 complete months. It's either shorter than 12 months or longer than 12 months. So they will use the word period to show that this is not exactly 12 months. Now, when you see year ended or year two, this is exactly 12 months. So these are the things you should know. So this is a period ended. So you now ask, how many months are in this period? If we start counting from April 1, 2006, you will say April is 1 month, because from April 1 to April 30th is 1 month, to May 31st is 2 months, to June 30th is 3 months. So April 1 to June 30 of 2006 is 3 months. But if you observe here, this is June 30, 2007. So there's another 1 year from July 26 to June 27, 12 months. Add 12 months to 3 months you've calculated, it means that this period here is 15 months. So this figure here contains a 15 months figure, while here are 12 months figures. So required, compute the accessible profits of the company for the relevant years of assessment in line with the rules of commencement of business. And so when they use the word and, it means the question is to the alternative available to the taxpayer. So first of all, let's look at the commencement rule. The commencement rule states that for the first year, because the relevant years in a commencement rule is 3 years. So these 3 relevant years are the year 1 the business started, year 2, and year 3. These are the relevant years of assessment. So if you look at year 1, which is, how do we know that this is 2006 year of assessment? All we need to know that is in the first year, the date that the business started is in the year 2006. So that makes the year of assessment to be 2006. Now, what is the basis period? How do we get the basis period? The basis period for year 1 will be from this date that the business started down to December 31st of that same year. So it's going to be an actual year basis. So it's going to be from April 1 to December 31 of that same year. So you see it's going to be of the same year. So what do we do? If we count April, May, June, July, August, September, October, November, December, is 5 months that we are looking at. This basis period collects 5 months. So we can find April 1 here, and we can still find December 31st of 2006 here. So it means we are taking 9 months out of these 15 months. So that's what we did here. 9, accessible profit is going to be 9 out of 15 of this figure. So when you do it, you're going to get 1,080,000. Now that's your first year of assessment. What is the second year of assessment? The second year of assessment, you will still refer to the date the business started. Of course, you know the second year of assessment will be the next year, not the same year again. To be the next year. From 26 we go to 27. It will start from the date the business started, just like this one started. So that's why I said that date of commencement, you will use it twice. So the date the business started, you will give exactly 12 months. So you start counting from April 1 to 6. When will that year end? If you are getting 12 full months, is going to end in March 31st, 2007. Now, because we are starting from the date the business started, we are still using this figure. So we have 15 months here, and we started from the beginning. So we are taking the first 12 months. So it is 12 out of 15 multiplied by this same figure. So you have your answer here, 1,440,000. Now that's your year 2 figure. Now coming to year 3, year 3 figure does not need to consider this initially. All it needs to consider is the date the account is being made up, June 30th. So look at how year 3, which is very important for us. See this year, this is 2007. So year 3 must be 2008. That's one. The second thing is that year 3 follows what we call preceding year basis. And what is preceding year basis? Precede means something that comes before. So if I say, if this event precedes another event, that means event A came first. And so event A precedes event B, means event A came first. So if I say preceding year, I am asking you to go back to the year before. That means that if I'm saying we are using preceding year basis, it means the ending date of this account must be 1 year before this year of assessment. So if this is 2008, it must end in 2007. That's one. Secondly, see this June 30th that the account is being made up, it must then be June 30, 2007. Now, it has complied with the word preceding year basis. So you must not find anything 2008 here in this basis period. Everything must end in 27. Now, third thing it must comply is that it must be 12 months long. So that means that if this figure, if this month, if this ending date is June 30 to 7, count 12 months back, you arrive at July 1, 2006. But to save you the stress of counting backward, all you need to do is, if today is June 30, what is tomorrow's date? July 1. That is this one here. Then you just remove 1 year and make it 2006. That is how you count backward. So if you are counting backward, from here, you want to go to the beginning. Instead of counting backward, just count 1 date forward and say, what is tomorrow's date? You put tomorrow's date, put last year. Now, if you are going to count forward, you do the opposite. If this one is April 1, you want to count how many months forward? Just count 1 day backward. What is yesterday's date? March 30. Then you add 1 more year, it's 2007. That's simple logic. Now that you've known that this is 12 months, you're going to ask again, July 1, 2006, where can we find it? We can only find it here. July 1, 2006 must exist in this account that ends in June 30, 2007. Now, it means that this account also ends in June 30, 2007. That means this account for the 3rd year ends on this date. So that means we are taking 12 months out of these 15 months. So you see, we are doing the same thing we did in the 2nd year. We are doing 12 months out of 15, which is 1440. Now, after doing the first, second, and third year, you simply just add the second year and the third year together. So that's what you see here. Say sum of year 2 and year 3, which are these two figures, and I'm getting 2880. Now, what is the reason for adding these two values? It is because in the second question, when they say use the alternative method, you're going to be comparing this figure with the alternative figure year 2 and year 3. Okay, now let's look at the alternative method, which is called the right of election. In the right of election, there is no business. We don't have any business in year 1. So this year 1 we did here is exact replica of what we did here. So it's exact replica. So year 1 is the same. Nothing touch year 1. So year 1 is not a deciding factor. Now go to year 2. The reason for this right of election is this. Because you have done year 1 on actual year basis, you want to do year 2 at actual year basis and year 3 at actual year basis. Remember, in this commencement rule, we said year 1 is actual year basis from the date the business started to December 31st. But for year 2, we are just doing a different method. From the date the business started, count 12 months. Year 3, you look at the end of the accounting date. It must be preceding year basis and count 12 months back to get where it starts. Now, but in the case of right of election, I'll concentrate on the year 2. Year 2 must be January 1 to December 31st of the same year. Year 3 must be January 1 to December 31st of the same year. That is why we call it actual year basis. Now let us see what we'll do now. Where can we get January 1, 2007 account? So you look at here, this we have June 30, 2007. That means January must be inside here. So from January to June is 6 months. So we are going to take 6 months here, 6 months here out of this account. So that is what I did here, 6 months out of the 15 months account, which is this. Then we have done January to June. We need July to December. So July 1 will be, of course, here. And up to December is another 6 months out of this figure. So we say plus 6 months out of this 12 months figure. So when you do this separately, you get a value. You do this separately, you get a value, you add them. So let's see how you can do them together. Let me see if I can on my calculator here so that you can work with that together. So calculator. Okay, so I will be sharing my calculator screen so that you'll be seeing what I am doing. All right. So calculator, we'll say the first one here is, sorry, is my calculator being seen? Okay, good. 6 over 15 times 1,800,000. You have 720. So if I were you, I would just store it. 720. You come again, 6 divided by 12 times 1,500,000. You have 750. Now you will now add the 720 that you had before. It gives you 1,470,000. So that's what your value is, 1,470,000. That is how we got this figure here. Then you go to the last year, we say it is from January 1, 28 to December 31st, 28. So you ask yourself again, where can I get January 1, 2008? We have June 2008 here. Of course, here is June 2007. So January cannot be here. January 1, 2008 must be here. So from January to June is another 6 months. So we're going to look for 6 months of here. Then the remaining 6 months, we are getting it out from here. So that's what we did here. 6 months of this figure, 6 months of this figure. So here is 750, here is 900. 900 plus 750 will give you 1,650. Now, we are going to sum the 2 years, year 2 and year 3. So we are using just this and this. So when you sum them up as we did here, we are getting 3,120,000. Now, can you see now we are going to compare this 3,120,000 with 2,880,000. If you are given the option that which of these two bases will you be using to assess yourself to tax, common sense will tell you that you don't want to pay more tax. You will prefer to pay 2,880,000 for these 2 years than to pay 3,120,000 for these 2 years. Of course, you know the first year is the same as the first year here, so it's not a deciding factor. You must pay this 1,080,000. But for these 2 years following, you want to prefer this method, and so you will not exercise your right. So that's why I say advice here: do not exercise right of election. Don't choose the alternative. I believe this was clear. So the second question now will now be on the change of accounting dates. Now, when a company is changing its accounting date, there are principles it follows. Leah, the trading company, decided to change its accounting year end from March 31 to December 31 of each year for administrative convenience. Now, you see, it means that previously they were sending their financial statement and it will be reading year ended March 31st, year ended March 31st, until such a time that, wow, they change. Year ended or period ended December 31st. What could be some of the reasons why they want to change the accounting date? Perhaps they became a subsidiary under a parent, and because the parent was December 31st, because they have to do consolidation, they have to change from March 31st to December 31st. It could be because of a government directive that a particular industry be deciding to use that as for convenience. It could also be because of administrative convenience, as they said. Fine. Now that we've seen that they've changed from March 31 to December 31, what do? They said its 2007 assessment was based on its account from April 1, 2005 to March 31, 2006 on the preceding year basis. So how do we know it's preceding year basis? This is the year of assessment 27. The account ends in 26, and it's exactly 12 months preceding year basis. Now, they have told you that 2007 was based on preceding year basis. It is likely that the next period they want to change to the December 31st period that they gave you. Okay, so now look at what you are going to do. First, you are going to look at, they said, compute the accessible profit of this company for the relevant years of assessment. Now, the relevant years of assessment are also 3 years. This relevant year is going to be 1. The year you first notice a change. The year you first is the first year. The year you first notice a change is your first year. Then the second year is the year after that first year. And the third year is the year following the second year. The company was doing March 31 every year. So when you see year, so this is year, they now give you 1st April 2005, which is what they told you, to 31st March 26, and they told you it is 12 months. Because this is ending in 26, it is 2007 year of assessment. Is it fine? Now look at the second one. You are not saying period. Now this word period is an indicator that a change has happened. So you ask yourself, which year of assessment did this change occur? Now, how do we know this is 2006? So what does it tell you? This other account in 2007. So in 2007, irrespective of the fact that they gave you up to March 31st, which is 12 months, the remaining one from April to December, which is 9 months, they also brought it as 2007 year of assessment. So that means we have 2 accounts in 2007 year of assessment. So what we need to do is identify the year that the change was done. 2007 is our first year because the change was done in that year of assessment. So that means our year 1 will be 27, year 2 will be 28, year 3 will be 29. Now, what is the formula? The formula for year of accounting, change of accounting date is this. First, you will work based on the old accounting date, which ends in March 31. How do you do that? You will pretend as if the company has not done any change. It means even if the company is telling you, we have changed to March 31st, to December 31st, pretend as if you didn't hear. Go on using March 31. So if you look at it, your first relevant year, which is 2007, was April 1 to March 31st to 6. Your second relevant year is April 1, where this one stops, it continues. April 1, another 12 months to March 31st, 2007, preceding year basis. The third year is where this one stops, this one will start April 1 to 7 to March 31 to 8, preceding year basis. That is fine. So now let's work it. April 1 to 5, which is this figure here, April 1 to 5 to March 31st to 6. They say 12 months. You were given the 120. Bring it exactly that. That is this. Now, the next one is April 1. Where are we going to find April 2 6? Now we need to get up to March 31st to 7. But these accounts end in December 31st to 6. So we'll take this 9 months account first, which is 79,000. That's why you see it here, 79,000. Then the remaining 3 months, we are going to take the remaining 3 months out from here. So that's why you see 3/12 of this figure. So 3/12, 3/12 times 240 will give you 60,000. If you add that to 75,000, you are getting 135,000. So that is this 135,000 you got here. Now you go to the 3rd year. What do you do in the 3rd year? The 3rd year is supposed to start from where? April 1. So you ask, where can I get April 1 to 7? Look at 2007 accounts. It starts from January 1 and ends in December. So that means April must be inside here. So from April to December is 9 months. So you are taking 9 months out of this 240. That's what it means here. Then the remaining 3 months. The remaining 3 months, you're going to take it inside this figure. Because this 12 months figure. They're going to take the remaining 3 months inside here. So the 3 months inside this one plus this 9 months of this. Let's look at how it's going to be like. We have we have 9/12 times 240. That will give me 180. You store it. Then you come again, 3/12, 3 divided by 12 times 28,000. That will give you 7,000. 7,000 plus 180. That's going to give you 187. So that's how we got this 187. So just like we did in the first commencement rule, but this time we are summing the 3 years. They're not summing just 2. In commencement rule, we are summing the 2nd and the 3rd year. But in change of accounting date, remember this is not year 1. This is first relevant year. So this first relevant year could be year 5, could be year 6, it could be year 10. It is the year that you first notice a change in accounting dates. That is what we call first relevant year. In commencement rule, we call the first relevant year, year 1, because that is the year you start business. But in the case of change of accounting date, it is not called year 1, it is called first relevant year, because year 1 would have concluded since, but this is the first year you experience a change. So you add the first relevant year to the 2nd relevant year to the 3rd relevant year. 3 of them will give you 442,000. So that is what you will do when you are looking at the old accounting date. Now you will come again and say, based on the new accounting date. Now, you are saying, okay, you guys have changed your date, right? I've accepted. Let me work with it. So you go back again to 2007. Now, you are going to be looking at the new accounting date. Mind you, this is 2007. It must be on preceding year basis. So it must end in 26. And since the end date is December 31st, this must always be December 31st. So it must have started in January 1, 2006. So how do we get January 1, 2006? Now, we see 2005 here and we see 2006. So January must be here. So we have January down to March is 3 months. So we'll take 3 months out of this 12. That's why you're saying 3/12 of 120. So when we do it, 3 divided by 12 times 120 should be giving me 30,000. That's good, 30,000. Now, we have taken 3 months. Where are we going to get the remaining 9 months? It's going to be from April 1 to December 31st to 6. So they gave us our 9 months figure, 75,000. So when you add 75,000 to 30,000, you are having 105,000. So that's what we did to get 105,000. Then you go to the next one. January 1 to 7 to December 31st to 7 is straightforward because they have started filing according to the new accounting dates. So that's it. You pick this figure here and you put it. You go to the last year, you pick this figure and you use it. So that's what it is here. So now, what you should know about change of accounting date is that when you are working on the old accounting dates, the first relevant year you will not have workings because that is how they have been filing it. They have been filing it like that. So you just take it straight. It's the second relevant year and the third relevant year that you will do workings. When you go to the new accounting date, it's only on the first relevant year you will do workings because that is the year of change. The second and third relevant year, there will be no workings because that is how the company has been filing. So now what you will do again is to add these 3 relevant years. Like you did before, when you add all of them, you are having 373,000, comparing with 442,000. Now when you compare, now, in the commencement rule, it is the taxpayer that chooses which one he will go for, and the taxpayer will choose the smaller one, right? But in change of accounting dates, the taxpayer cannot choose. It is the tax authority that will choose which one they will collect. So they will choose the higher one. They'll say, okay, though you've opted for change, but for these 3 relevant years, we are taking this 442. After these 3 years, anything you bring on the old accounting date, on the new accounting date, we'll be taking it like that. Now, this shows you that you can not change your account date when you are commencing business. It means, 1, in your commencement of business, you have 3 years. First year, second year, third year, you cannot change your account during the first 3 years. You can change your account from year 4. It's likely you can change your account from year 4. So if your account changes from year 4, so there's no way you can be doing commencement and change of account in one particular account. So from year 4, you can change your accounting dates. Fine. Now you cannot be doing changing of accounting date and also be doing cessation rule. So now let's go now to the cessation rule and see how our cessation of business is going to look like. Now, cessation of business here, exercise 1.3, Grace Limited has been in business for many years. Of course, for it to be in business for many years, it's not a small company, it's not a startup company. It must have been given its account on preceding year basis. As a result of the global economic meltdown, the business declined and Grace Limited ceased trading permanently on September 30th, 2019. That date is important. Okay? Now, in the change of accounting date, the period of change is important, and the 2 dates that they change is important. But when it comes to cessation of business, the day the business ends is very, very important. Now, look at the adjusted profit were as follows. Previously, the business was giving its account to June 30th every year. You can see the trend. It's June 30th every year, June 30th every year, June 30th every year. But now it could no longer give it to June 30th. This is not a change of accounting date, please. This is said that the business ceased. And when the business ceased, nothing else come under. Okay, they said compute the accessible profit for the last 3 years. When they say the last 3 years, it means 2009, 2008, and 2007. Okay, going to be 2009 year of assessment. Now, when they say last 3 years, get it right, because they are their basis. When it comes to the data, now, so you see, there are 2 periods of time you have to use actual year basis. The day you start your business, from the date the business starts, year 1, you use actual year basis. Now, when it comes to the day the business is ending, you also use actual year end. So it then means that you cannot know when your business is going to end in the preceding year. You will know when your business is going to end when it ends. There is a name we call the year the business ends. We call it ultimate year. Then we call the year before the ultimate year, we call it penultimate year. In the penultimate year, you may not know that the next year will be an ultimate year. So in that penultimate year, you will not know that that's a penultimate year until you first experience your ultimate year. And you say, okay, that means the year before was a penultimate year. So first thing to do is locate the date that the business ends. 2009, September 30. That means the relevant year of assessment, the last of the 3 years must be 2009. That means the year before 2009 must be the penultimate, 2008. And the year before the penultimate is supposed to be what? 2007. That is what they are telling you. Last 3 years of assessment. This is how you are going to count it. Count 29, 28, 27. That's one thing. Now, and justify the option open to the FRS. So what do we do here? Look at what we do. Look at Grace Limited. Okay. So since we know that it's ending in 29, so we say 29, 28, 27. So you go and start with 27. In 2007, nothing spoiled. You have been given your account in preceding year basis. And we said preceding year basis, it must end in 26 on the accounting date that the company chooses. So 26, June 30th, it must have started in July 1, 25. So what do you do here? This is the account that we are talking about, ending in 26, and they say year end. So you take this figure, 564,500 straight and put it here. Nothing spoiled. Now the second year, which is the year before the business end, we call it penultimate year. Normally, you will not know that that is a penultimate year until you get to the ultimate year. Now, when you have realized that this is a penultimate year, naturally, you would have done preceding year basis, just like you did here, because you never know the business was going to end. You prepared your account on going concern. Now, this is the going concern, the preceding year basis. July 1, 2006 to June 30th, 2007, because this is 2008. You go here, that is the figure here. This figure. So you come here and you put the figure here. Mind you, I have not put it here yet. Now, because you have realized that this is the penultimate year, you will come back and say, okay, the law says that in the penultimate year, after doing PYB, you will come is actual year basis. So after doing this year is year 2008, right? Fine. Go and start. Actual year basis means January 1 of that same year to December 1 of that same year. Sorry, this is 2008. Sorry, it's a typographical error. This is 2008. To change it, 2008. So this is a 12 months figure. So how do we get this 12 months figure? 2008 January. Where do we get 2008 January? We are going to get it here. From here to June 2008. That means it's a 12 months figure. So you take 12 months out of this. So you say, sorry, 6 months. The 6 months figure, so January to June. You take 6 months out of these 12 months. So you say 6 over 12 of this figure. Find it and keep it one side. Then where is July to December of 2008? You have July 1 here down to December. So you're going to take another 6 months out of 12 here. That's what I just did. So what we do now is 6 over 12 times 398,000. That will give me 199,000. 199,000. Sorry, let me do it again. 6 over 12 times 398,000. That will, sorry, that will give me 199,000. So when I get 199,000, I will come again 6 over 12 times 265,000. I will get, sorry, 6 over 12 times 265,000. I will get 132,500 plus 199. I will have 331,500. So you see, 331,500 is what you got when you did actual year basis. What you did when you did preceding year basis was this. So now the tax authority will not be the one to choose. So you're not adding anything. You're just looking at it. In this penultimate year alone, which of these two bases is higher? Of course, this preceding year basis is higher. The tax authority will choose the higher of the two. So that is why you see me, I put the higher one here. If this one was higher, that is what should have gone here. Now that you've settled the penultimate year, the ultimate year is going to be on preceding year basis. This is because this one has ended in December 2008. When you are comparing penultimate, preceding year and actual year, you have considered up to 2008 December. So your ultimate year is always going to be on actual year basis. So it's going to be January 1, 2009 to the date the business ended, September 30th, 2009. So where did we get January 1, 2009? January 2009 must be here. So from January to June is 6 months. So I'm going to take 6 months here out of this. This is what I did, 6 months here. Then the remaining 3 months from July to September is this figure 19,000. So I just bring the 19,000 straight. So when I add them up, I'm getting 151,500. So that is how you do the ultimate year. So you see here, the tax authority will choose the higher of the two accessible profits in the ultimate year when assessing the company for tax. So you see here, one. Now, before we take exercise 1.4, which is going to be like a summary of everything that we've been doing here, let me reiterate what we just did in exercise 1.1 to 1.3. First of all, in exercise 1.1, we are doing commencement rule. In commencement rule, the rule states that you start from the date the business commenced down to December 31st of that year. Actual year basis. The second year is on normal basis going to be from the date the business starts, 12 months from the date the business starts. Then the third year will be 12 months ending on the accounting date chosen by the company, which is in preceding year basis. And after you do that, you add the the second and third years together, and you get a figure. Then you come back and do the second and third again. I just decided to do the first one here just to show you something. This one is not needed to be done. Do the second and the third again. But this time on actual year basis. So everything is 2007, everything we end in 2007. Is 2008, everything we end in 2008. So it's got to start from January 1 to December 31st of that year. January 1 to December 31st. So when you do that, you add the 2 years again, and you get a figure. So what you do is you will now compare the 2 years you've just done in the right of election to the 2 years of the normal basis. Whichever is smaller, the taxpayer has the right to elect or choose the smaller one. So if this one here is going to be the smaller, this second option, then you will say you should exercise your rights. But if it's not the smaller one, you will say do not exercise. Now, when it comes to change of accounting dates, it must be that there is a preceding year basis going on already. Perhaps from the 4th or 5th year, you can do your change of accounting date. So you have to note the day, the year of assessment, when there was a change. When you notice that a change has occurred here, then you note that as your first relevant year. So you will get 2 other years after it. So how do you do it? From your first relevant year, keep pretending that they never experience a change. Keep working on the old accounting dates. You do your preceding year basis normally from the first relevant year of change, second relevant year of change, third relevant year of change. You add the figures together. Then you go and pretend as if they now changed. Now, you now go on the new accounting dates, go back to your first relevant year, work with it. Second year and third year, you add them together, you get a figure. You compare them. And now you don't have the option as a taxpayer to choose. The tax authority will choose a higher one. So you will go and pay the higher one. Now, when it comes to cessation rule, all you need to do is to know this ended. That year the business end is called the ultimate year. Now, when you get your ultimate year, The year before the ultimate year is called the penultimate year. Now, what you need to know is this. In the penultimate year, that is the year of deciding which which tax you will pay. You first of all have done your preceding year basis and get a figure. You come back again and do your actual year basis and get a figure. Now, you don't have any choice. The tax authority will choose the higher one. So that's what you're going to do. Then, the ultimate year is always done on actual year basis. So that is what you should know. Now that we've talked about it, let's go to the last question. Now, this question is very, very comprehensive. In fact, if you can understand exercise 1.4, it shows that you have understood everything that we've done today. CAN Limited commenced business. So it's underlined here, commenced business on what date? On October 1, 2001. This date is important in commencement rule. We are going to use it on year 1. We are going to use it on year 2. That's fine. The company, however, chose December 31st as its accounting date. That means from year 3 downwards is going to be giving us on December 31st every year. Tax year 2006, the company wrote to the FIROS notifying the Revenue Service of its intention to change its accounting date to March 31st, 2000, March 31st. So not this day, this year. That means this year is going to be your first relevant year. It's going to be your first relevant year in your change of accounting date. So you need 26, 27, 28. In the commencement rule, you need 21, 22, 23, 203. Now in the change of accounting date, you need 206, 207, 28. Now, later in the year 2010, due to harsh economic recession, the company collapsed and folded. So 2010 is your ultimate year. Count back, it means 2009 will be your penultimate year. So if I were you, I would just be scribbling those things down as a notation on my question paper. Now that you've known that, you were given the following accounting information when the company started operations to when it ceased to exist. Okay? They were giving you period to 31st October 2001. If they have started the business on October 1, and this is October 30th, it simply means this is a 1-month account. Now, I should expect that since the company is choosing 31st December as an accounting date, I should have expected that this cashier or the accountant keep presenting to October 31st. So it is not your business to adjust it to December. How do you do it? That's a skill you need to acquire in this question. Now, here, they now change to May 31st. So you can see that they have actually changed. So they keep changing, they have changed, so they now present it accordingly. So there are 2 skills you will get to do here. You are going to get to do commencement rule here, and you are going to learn how to change or adjust your accounting dates, your accounting year end when they give you something incomplete. So let's see how we're going to solve it. Let's not talk too much. Now, let's look at the first year of commencement. The business commenced on October 1, 2001. So 2001 becomes our year 1. So year 1 is 2001, which will start on October 1, the business commenced, and must end in December 31st of that year. What is the assessable profit? We were given how many months here? October, November, December. So we are given 3 months in that year of assessment. Now, here is 1 month figure. Where do we get the remaining 2 months? We get the remaining 2 months from here. 2 months over 12. So this is from November 2001 to October 2002. So there is November and December here. So we are taking 2 months out of over 12 times 105. So this 2 over 12 times 105 will give you 17,500. If you add it with 18,000, you are getting 35,000. So you see that I have put it at the last place because there is no contention. 35,500 is what you pay for your first year tax. The second year, now this is normal basis. What do? Second year is going to be year 2002. And we said since the business started in October 1, we are going to still do your October 1, 2001. Count 12 months. Instead of you to count your fingers, I told you, if this is October 1, yesterday's date was what? 30th of September. Then put 1 year ahead of 2001. So it's 30th September 2002. So from October 1 to October 30th, they gave us 1 month account. That means we need 11 more months to make this 12 months. So that's why we said 11 over 12 of this same figure that we took here. You know, this we took 2 over 12. Now we're taking 11 over 12. So this is your 18,000 repeated here. 11 over 12 of this is going to give you 96,250. When you add to this, you have 14,250. You put it here first. Now going to the third year, it is when you start doing your preceding year basis. Your third year is 2003. Through 2003, but your account must not end in 2003. It must end on 31st December 2002. And so that's what we did here. It must end in 31st December 2002. That means it must have started January 1, 2002. So look, 2, of course, is going to be here. So from January 1 to October 31st is 10 months. So we are taking 10 months out of this 105. So you see 10 over 12 times 105. That's going to give you 87,500. Then where are we going to get the remaining 2 months to make it 12 months? We're going to say 2 months out of this 12, 120. So that's what we did here. 2 out of 12 of 120, you're getting 20,000. So when you add these 2 together, you are getting 107,500. So when you get 107,500, you sum this second and the third year together. So you add this with this, and you are getting 221,750. Now, you check if you need to exercise your right of election for the same commencement period. That will mean that you have to repeat year 2 and year 3. So when you get to year 2 and year 3, you are doing actual year basis. It means you must start from January 1, 2002 and consider to December 31st, 2002. So you ask yourself, where can I get January 1, 2002 account? Of course, it's going to be here. So from January 1 to October 31st is 10 months. So I'm going to take 10 months here out of 105. So you see 10 over 12 of 105, and The remaining 2 months will be from the 120. Exactly what we did in year 3 here. So it's going to give me 107,500. Then you go to the next one. It's going to be January 1 to 3 to December 31st to 3. So where do we get your January 1 to 3? Of course, it's going to be here. So you're going to take 10 months out of this 120, the remaining 2 months out of this 150. That is exactly what we did. 10 months out of 120, 2 months out of 150. When you analyze them, this is 100,000, this is 25,000. It gives me 125,000. Once again, you add your second year with the third year. When you add them together, you are having 232,000. So you ask yourself, this figure here, 232,500 and 221,750, which one is smaller? It is the smaller one you choose. So because this is the smaller one, you see me repeating these figures here again. So because I'm choosing them here, I'm putting them again here. If I had taken this one as the smaller, I would have been putting these ones here. So you get me? Now, after you've done that, your normal basis continue. When we say you continue your normal basis, what it means is that this right of election ends after here. Whether you even choose it or not, it does not mean that you keep comparison for you to know which one to choose for those 2 years. From year 4, you keep doing your preceding year basis. What does it mean? It means where this normal basis end, that is where this must continue. So this one ends in December 31st, 2002. This must be January 1, 2003. Mind you, this is not actual year basis because it's preceding year basis. This is 2004. Everything is ending in 2003. January 1 to December 31st, 2003. So what do? You go to where 2003 January is, because it's going to be here. So you're going to take 10 months out of here, 2 months out of here. That's exactly what we did. And we got 125,000. We put it here straight. Now you go to the next one, 2005. Where this one stops, that is where it starts. January 1 to December. Of course, taking 2 months before, you take the remaining 10 months here. So you see, you take the remaining 10 months from 2004, January 1 to October, take it here. Then, where is July to December? Sorry, where is November to December? 2 months here. You're going to take 2 months of November and December. But wait a minute. This is period. How many months are in this period? We have November, we have December, total 7 months. So that means we are taking 2 months out of 7 months. So that's what I did here. 2 out of 7 months of the 90,000 gives me 25,715. When I add these two figures together, I have 15714. So now that's for these ones. You remember again that they said in the tax year 2006, if your tax year is 2006 and there is going to be a change in the tax year 2006, the basis period affected is 2005. So if you look at it again, we've done 2004, we've done 2005, isn't it? Now we are in 2006, and we said that was the year that the change occurred. So We will first of all pretend as if we are using the old accounting dates. What was the old accounting date again? December every year. So it will mean that we use from January 125 to December 31st 25 preceding year basis. So once again, where is January 125? It's going to be here. So that means from January 1 to May, it's 5 months. So we're going to take 5 months out of these 7 months here. So that's what I did here. 5 out of 7 of 90,000 gives me 64,286. Now, if taking 5 months, where is the remaining of these 12 months? So 7 over 12 of this figure is what we are going to do. 7 over 12 of that figure gives me 73,500. So when you add these two together, you see I'm putting it here because I'm going to do comparison. 137,786. So this is my first relevant year of change. The second relevant year of change is going to be 2007. Once again, old accounting dates. January 1, 2006 to December 31st, 2006. Now, where is January 1, 2006? We're going to find it here. If it's going to be found here, it means January 1 to May is 5 months. So we're doing 5 months out of 12 months because you see this is year 2, so it's 12 months. But we're taking 5 months out of 12. So you see 5 out of 12 of 126. Now we've taken 5 months out of, so where is the remaining 7 months going to come from? So the remaining 7 months is going to come from here, which is from June to December. It's going to come from here. So you say 7 over 12 of 180. So that's what we did. 7 over 12 of 180 gives me 105. You add these two together, you are having 157,500. Now you go to the third relevant year of change. So I told you before, if not that we have been adjusting, normally you are not supposed, you're not supposed to do workings in this first year. The second year and the third year is when you shall be doing workings. But since we have been adjusting these figures because they gave us erroneous dates, that's why you see that we have been doing workings. Now go to the third relevant year of change, 2008. So it must be from January 1 to 7 to December 31st to 7. So where do we get January 1 to 7 figure? Right here. So from January 1 to May 31st is 5 months. So we're taking 5 months out of these 12 months of 180. So that's what I did here. 5 over 12 times 180. That's January to May. Where is June to December? June to December will be in the next period. So we are going to take 7 months remaining. 7 over 12 of 108. That's what we just did here. 7 over 12 of 108 gives me 63,000. So what you do here is you add 63,000 to 75,000. You get successfully 138,000. Now after doing these 3 relevant year of change, you add these figures together. Add these figures together. And what do you have here? 433,286. Now that's the sum of the 3 years. Then you will now come and say, based on the new accounting dates. So you go back, start comparing 26 again, 26, new accounting dates. So the new accounting date, they said it changed to 31st May. So what it means is that in the new accounting date, if you start with 26, that means it must end anything in 25. So if it is May, it must have started in April of the previous year. So from April 2004 to October, how many months? April, May, June, July, August, September, October. So you're going to say 7, sorry. Okay. So this is the basis period from June, sorry, since it is ending in May 2005, it must have started in June, not April. It must have started in June. So I gave you a principle and I failed to obey it. If this is 31st March, what is tomorrow's date? June 1. Remove 1 year. So it must have started in June 1, 2004. So you count June, July, August, September, October. So June would have been here. So June, July, August, September, October 2004, where it ends. It's 5 months. So we are taking 5 months out of 12. That is what we did here. 5 months out of 12 of 150 gives me 62,500. Now, we now deduct October. Now, November to May is this figure here. November to May, and we are ending in May. So November, December, the remaining 7 months is this figure. So you just take this whole 90,000 that represent the remaining 7 months. So you see, this is 5 months figure, 62,500. This is the 7 months figure, 90,000. Add them together, you get 152,500. Okay, the second year, relevant year is 2007. So what do? You also look at the new accounting date ending in May. So it must have started in June 1, 2005, ending in May 2006. So it must end in 2006 because this is 2007, preceding year basis. So look at the account that ended in May 2006. May 2006. And they say it's year 2. So it must have started in June 1, 2005. And it's ended in May 2006. So you take everything here. This is 12 months we are looking at. That's it here. Then the next one here, year of assessment 28. It must end in 27, May 31st, 27. So it must have started in June 1, 26. So go and look at the account ending in May 31st, 2007. Is this figure? And they say it's year 2. So that's the account you are looking at, 180. So when you've done that, you add these 3 together. When you add these 3 together, look at the figure you've gotten here and this figure you've gotten here. You compare which of them is bigger. The tax authority will take the bigger one. So that is why you see me repeating these figures here. These 3 figures here, because now the tax authority will take this in favor of this. So they won't take this. So because they are taking this figure, we are repeating it here. Now, mind you, this is 2006, 7, and 8. Then we said the business came to an end in 2010, the ultimate year. That means 29 is our penultimate year. You must write it somewhere because we've just finished 28. The next year we are going to do is 29. And that's the penultimate year. Now, we are continuing our account using the new accounting date because these 3 things has been considered. Now, even though whether we choose this or we choose this is not material, the fact that the FIROS has accepted that the new accounting date should be used, that would mean that the next year after this change of accounting, 3 relevant years must continue the new date. That would mean that where this one stops, that is where this will start. That is where it will start. So change this one to 27 here, sorry, instead of 28 here is 27. So where this one stops is where it will start. Mind you, when we are doing commencement rule and we are continuing the normal basis, and I said where this normal basis stop, that is where this one starts, irrespective of whether you're choosing right of election or not. Now, coming to accounting date, irrespective of these ones that you choose, old or new, for those 3 years, after that, the company will continue on the new accounting date. And ultimate year now is what is continuing it. So what we'll do now is, if 2009 means that you must do your PYB as a continuation of this new accounting date. So it must have started in June 1, 2007 and ending in May 31st, 2008. So what it means is that go to the account that ends in May 31st, 2008. So this is this 108. That is the 108 here. There is no adjustment. This is preceding year basis. Now you are going to compare with actual year basis. Actual year basis is from January 1, 2009 to December 31st, 2009. So what do we do? Where is January 1, 2009? Of course, it must be here. So from January to May is how many months? 5 months. So we are going to take 5 months out of this 130. So we are saying 5 over 12 of 138 rather. So where would the remaining 7 months come? The remaining 7 months have to come from here. So of course, this one extends to 31st January 2010. So that means from June, July, August, September, October, November, December, 7 months out of 8 months, because enter January. So we are taking 7 over 8 of 60,000. So that's what we're going to do. 7 over 8 of 60,000 gives me 52,500. When you add these two together, you have 1110. So you choose between 1110 and 108. Which one is higher? The tax authority is going to choose 110. So that is what you are going to do, choosing 110. Then the ultimate year, which is in 2010, is going to be on actual year basis. So the account says, the story says they end in 2010, and they gave you period to 31st January 2010. It means we're going to take January 1 to 31st of January 2010, 1 month out of this 8 month period. So we say 1 over 8 times 60,000, which is 7,500. So we put it here straight, 7,500. That is what this account is all about. So this account has shown us how we can do the commencement rule, seeing how the commencement rule was done. The first year, second year, first year takes from the accounting, the date the business started, down to December 31st. The second year takes from the date the business started, counts 12 months. The third year ends on the preceding year basis on the account choosing date. You count 12 months back. Now, you add second and third year, you get the figure, then you go to the right of election. You do the second and the third year again. This time, you're going to do actual year basis. January 1 to December 31st of 22, January 1 to December 31st of 23. So from there, you will know where you take your account. You'll be counting how many months are you taking, how many months account was given. So how many months are you taking divided by how many months accounts figure you are given. Must add the second and third years. Now, when it goes after the commencement, you continue from the normal basis. You don't continue from right of election. This one is just for comparison. So you continue where this one stops. Then you keep doing your preceding year basis. Now, when it gets to accounting date, check the year that you experience a change. The year of assessment, not the basis period. The year of assessment that the basis period does not correspond, that is the first relevant year. So the first relevant year is 26, then you will check 2 more years, 27 and 28. So you will do based on the old accounting date that you have been continuing before. You do that, then you come back again and do on the new accounting date. When you do on the new accounting date, you check the 3 relevant years, you add them up, choose the higher of the 2. That is what FIRS or any tax authority is going to look. Now, you keep continuing in the new accounting date. Now, it's just coincidentally that the next year is the cessation rule that we are activating because the business ended in 2010. So 29 becomes your penultimate year. When you get your penultimate year, you have to do PYB. Of course, the new accounting date becomes the new normal. So your penultimate year becomes penultimate year based on the new accounting date, not old one that has been changed. So PYB based on the accounting year end, new accounting date, gotten a figure, then you come again and do your actual year basis, January 1 to December of that year. When you do that, you compare once again and choose the higher one. Then you go to the last year, the ultimate year. The ultimate year, you are going to do actual year basis. We've done that and you put it down here. That's the end of the account. So thank you so much for coming to class today and for learning. And what will happen is this. In our next class, we are going to look at capital allowance. Capital allowance might take us 2 classes. We are going to look at capital allowance because that is a topic that you cannot escape and that will take much of your time. So we're going to see how capital allowance align with basis period so that when you are giving fine tax liability, you would have done your assessable profit, then you do capital allowance, then you do your tax. So we are going to see how capital allowance is going to work. Thank you so much for joining this class today. See you in the next class day, which is when? The next class day is Thursday with Adesua. So thank you once again. For now, I will say see you next week because my class for you is next week. Thank you. If you have any question, ask it in the WhatsApp group, please. Chat me up privately or in the WhatsApp group. Do have a nice day and sleep well.